Good evening. So today we have an opportunity in the west of Melbourne, in an area called Tarneit. It's a very, very, very famous suburb especially if you're not from Australia, if you're born overseas. Tarneit is a very well-known suburb internationally. It's very famous for the population and demographics there, and just the cultural diversity you will find in Tarneit. Now, before I go in to talk about the opportunity itself, I wanted to shed more light as to why we are investing in Melbourne, number one, in 2024, and why we are investing in Melbourne in 2025. So this is going to cover the next 2 years basically on why we are investing in Melbourne, because what I'm finding is there is some really, really, really key hotspots that are within the Melbourne market where I'm seeing a lot of movement in terms of the property market. Valuations are going up. Rental yields are also going up, and our clients have been able to use that to their advantage to just generate some instant equity. But not only that, we are looking further and beyond in terms of capital growth in these suburbs that I've been sharing. So this week, the whole of December, I'd say not the week, but the whole month of December, my focus is on sharing free game on all these locations as to where we are looking at investing in next in terms of the Melbourne market. So I'm going to start off with Melbourne. Now, Melbourne itself, if you go back to 3 years ago, or 2 years ago rather, Melbourne has consistently, over the past 5 years, actually, not 3 years or 2 years, over the past 5 years, Melbourne has consistently been in the top 5 or top 10 of the most livable cities in the world. And the reason why that is number one, affordability. It's very, very cheap to live in Melbourne. Actually, in property terms, Melbourne is actually the cheapest place to buy property right now. There are some really good spots that you can buy the cheapest properties in the whole country. Now, why am I saying this? Because it also denotes to, when you look at a migration perspective, right? If we're going to narrow down into how Melbourne is actually growing, you've got the biggest population. Melbourne as a city is actually now bigger potentially than Sydney as a city compared bar to bar. And the reason why that is overseas migration is just coming in and it's going big, and hence the reason why you're seeing a lot of people move here. Now, if you were to talk into actual numbers, so you've got 4.3 million people who've moved to Melbourne by 2011, and then 5.3 million in 2024, which is an 18% increase, and we're expecting it to be 8 million by 2051, which is really, really good to note, because from a base level economic understanding, more people demanding housing is obviously going to push the property prices up. And we've already started seeing this. We're not, number one, we're not building enough houses in Melbourne, in the whole country rather. There's a housing shortage. And if you have a location where the biggest migration pool is actually going there from an international level, that area is set to just do nothing but one thing. Now, I want you to understand it this way, right? Out of the total 1 point something million people that are expected to come into the country, new migrants into Australia, 60% of those people actually go between two places. Now, one of those places is Sydney. Obviously, Sydney will always have a higher population number in terms of migration. Why? You've got the overseas students, you've got the investors, you've got tourists. Most people know Sydney. It's a very famous city worldwide. But the second place where people go to is actually Melbourne. And that's what's pushing and what will push the property prices into the coming 2 years, is the number of people that are moving here. But not only that, the number of jobs we are producing here as well as partnered with the number of infrastructure we're putting here. There is a shortage of housing already. More people coming in, which is putting more pressure on the housing. But what we are doing is we've found with some of our builder partners, we are actually helping some of our investors provide housing to the people that can't buy right now, or that can't afford to buy a property at all. So that's what our main focus has been, is just helping our clients understand why Melbourne right now is the best place and why it's a hidden gem. Just compared to what we've seen over the past 7 years happening between Brisbane, the same thing happened in Perth about a couple years ago, and just this year alone, we've seen the same factors play out for Adelaide. As soon as they announced the enhancement of the first home buyer grant, the property market in Adelaide has so much as doubled. In fact, we've got clients of ours that bought properties that are still in construction right now, and those properties have already doubled up in value before they even get the keys to the house. And we're seeing the same factors that have happened also in WA. If you look back a couple years ago, WA, you could still pick up a beachfront property at around 400,000, 450. Good luck getting anything under 800,000 in those locations. So these factors is what we're seeing coming here into the Melbourne market, and hence why I am educating and just advising a lot of our clients to pay attention to the Melbourne property market, especially with these opportunities that we have and that I'm going to be talking to you about. Now, I'm going to skip quite a lot of things. As we understand, property markets are never it's never a straight line sort of growth pattern. There's going to be dips and highs, and I wanted to highlight on that. To not when you're judging or when you're paying attention to a property market, a lot of people would look at the past 12 months and judge it by then, which is where Melbourne is right now. Some locations have had a negative growth within the past 12 months, but that's caused by multiple factors that I'm not going to go into right now. But the best way to judge a market is looking at a 10 to 15 year average. Why I say that? Because that's a long enough time for you to judge whether or not a market is sustainable to invest in or not. But if you look at the past 12 months, it could be anything. It could be the politics have affected that. We had an introduction of a land tax that came into Victoria not long ago in the past 12 to 18 months. That's affected a lot of investors' view, and a lot of investors' appetite on Melbourne, which is why right now a lot of the markets are actually driven by owner-occupiers as opposed to investors, because a few investors are feeling the pressure of the land tax, of which when you calculate it on size, say for example you own a 300 square block of land and it's valued around 350,000, your land tax is only 1,200 to 1,500 per year. It's not a significant amount, but a lot of people have bought 4 or 5 properties in Victoria, so that amount adds up, and hence why you're seeing some investors run out of the Melbourne market. It's not necessarily because the land tax is 30,000 on one block of land. That's not the case. But if you have multiple properties, the bigger the portfolio is, the bigger the valuation you have, then the bigger the land tax. So hence why I'm saying, if you're paying attention to a market and you look at just 12 months, you're probably not going to get enough evidence or enough value to actually judge a market on. So you need to look at a bigger threshold, and hence why I'm putting this right in front of you, as to say where 2024, in 2014, where the property market was, it slightly dipped, and then it went up again, and then 2022, 2021, because of COVID, we saw a huge change in property prices, and then of the past 12 months, we also see some stuff change. Now, another thing to note here is I want you to pay attention between these two cities. So Sydney is right here in the red, and then just beneath that is the Melbourne market. If you can tell how correlated these two markets are, and look at the population trends, and look at the property price trends, there's a huge correlation between these two markets. However, though, at this point in time, a lot of the clients we do speak to do not have enough borrowing capacity to be buying in Melbourne, in Sydney. However, there is another opportunity, which is the sleeping giant, and I call that Melbourne. That's where most of the our investor clients are going into now, because we understand over the next 3 years, over the next 2 years, we're going to see some really positive growth in the Melbourne market. Now, strong population growth, that's number one. We've got limited land supply. Yes, it does seem like we have a massive city and there's just land everywhere to be developed and land to be sold. Regardless of that factor, when you really hone down and actually pay attention to what's happening in the market, we do not have enough housing. And that's just the problem. And there is a few solutions which I'm going to talk about how we are helping our clients fix that. We've got number 3, infrastructure development in the country. As a state, and our economy is relatively a little bit more stable as of now. We've got a huge job creation pool, so 41,000 jobs in professional and science and tech services that are being thrown out. You've got 52,000 jobs in healthcare and social assistance, 39,000 jobs in education. You've got about 2.7 million people that are employed and working, and a very low unemployment rate in Victoria. It's a very, 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 very good place to invest in. Now, let's go on to the opportunity that I'm talking about. I did mention that this is in Tarneit. It's right within this pocket right here. This estate is called Marigold Estate. Despite of what the images look like, most of these places is actually built up now. I don't know why Google does this, where it fails to upload real-time imagery of most locations. But where we are right around here is where the property is that we are talking about, and just across the road here you got a fuel station and a KFC for the KFC lovers. But that's not why we're talking about this location though. We are talking about it because of how close we are to amenities. Now I'm going to start with the nearest train station. So Tarneit train. All right, Tarneit train station. Now, if we were driving there, it's just anything shy of 3 kilometers, 8-minute drive, 36-minute walk. It's literally down the road. It's just right there. As you can tell right now, there's a bit of traffic over there, but that's where the train station is. It's pretty much down the road from where you live. So that's number one. And then you've got Tarneit Shopping Centre, which is right across. So you've got the you've got the train station right here. So train station is right here, and you've got train station parking in abundance right here. And this is the existing train station, by the way. There's another one that's coming up. And right across that, you've got a Bunnings just right here. And then after that, you've got right here, they've built a Starbucks and a few food outlets here. I think it's Charles Burger, or Carl's Burger, not Charles, sorry, around here. And just some wetlands. Behind here, it's a whole estate. This is all going to get built up, if not built up already. There's some houses behind here. And then over across the road from the train station, which is why I'm saying the location itself is highly sought after right now. The demographics are very well, tightly held, and you've got a very diverse population down in Tarneit at the moment. So you've got the library here, and then you've got the fire station somewhere around. That's the fire station, and just right across. So again, train station right there, shopping center right there, and at the shopping center you've got things like Coles, you've got a fuel station, you've got Kmart there as well, you've got the gym and a few other things as well, like a healthcare center. You've got the Audi. So all your day-to-day shopping can be done right here at Tarneit Shopping Center, and then across the road you've got McDonald's, Subway, and another fuel station. Now these are the closest amenities that we have. However, if we go just across the road to Truganina, which is the next suburb to us, hence why I was saying this is a very, very Truganina central shopping. Okay. What did we do here? All right. Now, if you look on the map here, it's just about a 10k drive you get out of the estate, and then just down the road. Again, these houses are all built up. It's an existing road, established area already. You've got Truganina Shopping Centre. This is fairly new, but you've got another shopping centre there, shops, Coles, Woolies. All your day-to-day shopping can be done here as well. And then further down the road, you now enter into the Truganina employment sector. Now, in overall, you've got more than 4,000 people employed in this location, and going up and up. So a lot of people who are living in Truganina and Tarneit at the moment are actually people who are employed in this major industrial and logistics hub here. And that's not so far from the city as well. Hence why I'm saying, going back to the aspect of how lucrative this opportunity is, property prices have been very, very, very very affordable in this location, and for the opportunity that I have that produces the type of cash flow we have, this is a very, very good opportunity to pay attention to. Now, before I dive more into the location, I just had to zoom out a little bit more so you can see how big the employment sector is. So that's Truganina, you've got Laverton here, and this whole employment sector here is servicing the western part of Melbourne, and that's not far from where we are. That's just about I'll put Coles distribution here so you can see how far it is from the house that I am going to show you in just a moment, and the reason why we are having this structure of a house. So Coles distribution, all right, perfect, done. Now, that's just 25 minutes away. Imagine driving home 25 minutes away from where you work. And this is peak hour. It's only 12 kilometers from an employment hub. It's peak hour right now. Traffic is going crazy. Imagine in times that are not peak hour, that time could easily slash down to 20 or even under 20 minutes. Now, before I go further and talk to you about the actual opportunity that I have, I'm just going to go back and look at the numbers a little bit more. Now, what I have here is a house and land package for $805,000. It's a 5-bedroom, 5-bathroom house. And as you would imagine, that is what's called a core living property. Very lucrative. Now, what a core living property is, it's a standard house from an outside point of view. You look at that, it looks exactly like any other house. It's a standard property. You can own, sell it to a mom and dad if you are done investing in an asset like this. But it presents a unique opportunity, and the opportunity is cash flow. That's the main driver. The main reason why people invest in core living properties is purely just for the cash flow. So what it looks like, I'm just going to draw on here. Pardon me if it doesn't look great. So you've got bedroom number 1 here. Bedroom number 1, you enter through the door, and then bedroom number 1 will have its own ensuite and shower. And then you got the double car garage, which we charge about $25 per room or per car extra on top of your rent, and that is paid by whoever wants to have a car sport. And then you've got bedroom number 2. It's bedroom 4 here, but I'm just calling it bedroom number 2. Ensuite and a robe. We'll add in extra storage in every room, just like that. And then bedroom number 3, same scenario. Ensuite and a robe, and then what we do is we add in extra storage and a TV and furnish the whole house. Bedroom number 2, same scenario, and then as well as bedroom number 1. So what we do at the end of construction is we actually put a full furniture package in the house. So beds in every bedroom, we put extra storage in every bedroom, we put a small TV at some times in every bedroom, because what we want to do is create that hotel experience. You come in with your keys, you sign your lease agreement, everything is done for. You have a bed to sleep on, all you got to bring in is your clothes and maybe some bed sheets. And then you've got the kitchen and dining area. That is shared space, but everyone will have their own individual pantry, if you can see on that. So that's what a core living property is. So in an area like this where we are, where there's high employment and the demographics are very, very much diverse, right now as we speak, people are already subleasing, not core living, subleasing. Subleasing is, say, for example, I'm a tenant, I rent your house from you. I get people to rent out some rooms in the house to help me with my rent. So for example, me as a landlord, I'm charging $600 per week for the whole house as a 4-bedroom house. What I then do what my tenant will do as a tenant, they'll then get 2 of their friends to rent out 2 rooms out of the 4 and charge them $250 to $300 per room. And that means my tenant is actually not paying any rent. But the people that he's subleasing to are the ones that are paying rent. He's leaving rent free. So what we've done with this opportunity is we've just diverted that around, and made it so that you as the landlord will actually make the bigger returns as opposed to your tenant making that much money. Now, what does that look like per week? Now, this could rent out for $300 per room per week, plus the double car garages. That's even an extra $50 a week. But what we want to do is we want to work with the worst case scenario. So I'm going to assume we're going to rent every room for $250 per week in my calculation. So I'm going to go back here to my special little tool. I love this tool so much. All right, and I'm just gonna go. It's a house. We are building it. It's an investment property. Now, land cost, I forgot, so I'm gonna go back on here and just cross check. So 350 square meters of land, and that's going for 386,000 for just the land. So that's 386,123, and then 419 for the build. It's a big house, very spacious, suits everyone, an investor, an owner-occupier, a mom and dad. For example, if you've got teenage children, they want privacy, or you've got your parents visiting from overseas, they want privacy. This replaces having a double story with a single ensuite downstairs, and it's more affordable to build, very faster turnaround time. So this is your ticket to both wealth, but just creating a convenient lifestyle. So 10% deposit of that will become 80,000, and then you've got lender's mortgage insurance of 15,000, loan amount at 740. Now with LMI, you have an opportunity to capitalize that and put it on top of your loan, or you can pay it up front, whichever route you choose to take. And then you've got stamp duty, which is 18,000. Now, if we were buying this house as a completed house, we'll be spending about $45,000 on stamp duty. So you're saving almost $27,000 by building this house instead of just buying a completed property. Well, I guess the argument is going to be, if I were to build the house, won't I have repayments during construction? How much is that going to be? So what I want to do is take out this little tool that just calculates how much our holding fees are going to be during construction. I came prepared to this presentation. So, for example, stamp duty is going to be 27,000 extra on top. How much is it going to cost us to actually hold this property during construction? Now, I'm going to use 7%. And I'm going to assume, although we are building these in under 5 months, I'm going to assume a bigger time frame. So say 200 days during construction. Builder deposit, you'll be paying 10% deposit to the property. Construction, we said 419. And then we said the land was going to be, but we're taking away 10%. So 350 for the land, taking away the 10% that we are going to put down as a deposit. So 419 plus 40, so this is going to be 390. All right, perfect. So your interest in the worst case scenario, say the builder extends their time frame, they don't build in time, there's construction issues, etc., it'll end up costing you about $20,000, which is still a $7,000 saving when you're building instead of and this is the worst case scenario. All right, so it's going to cost you about $20,000 in holding fees. It's never been this much in my experience. For example, if we actually put in real time that we are finishing these in, say for example, it takes 160 days. For example, that becomes 14,000 in outgoing. Say for example, it takes 180 days to build. It'll only set you back about 16,000. But what I'm going to do is I'm going to work with the worst case scenario, because if you're comfortable with the worst case scenario, then the best case is also very good for you. So let's assume $20,000 in outgoings, which means in total you'd need about 121,130 for you to purchase this property to completion, including the furniture package, including all the outgoings with the property and holding costs as well. And that number could go significantly less if we build the house a little bit more faster. Okay, perfect. Now, we've got a 5-bedroom house, renting for $250 per room. So 250 by 5, that gives us 1,250. That's your weekly rental, which is 62,000 per annum in rental income. Now, you don't have any body corporate fees because it's a house. Your insurance, I'm just going to say 1,200 on there. This is an assumption. It's not financial advice. You have to sit down with us so we can structure this for you entirely. And then water charges, I always allow for buffer, so I'm going to say 800 since we have more tenants in there. And then I always allow for repairs as well. It's a core living property. At the end of the day, we need to get cleaners in at least every now and then. Then I allow for about $2,000 through the year to account for that. And then advertising and stationery, it's usually about 150 per room. Multiply that by 5, so we get 150 by 5, that's $750 for advertising, and then 8.9 in property management fees. That's because we're managing a bigger group as opposed to just one house. And then you've got land tax, the guys that we don't like. However, if you do register your property as a rooming house, you might get a rebate on that. But that's subject to you applying for it. Now, with the tax bracket, I'm just going to assume a 30% tax benefit over there. And then the depreciation, I'm just going to assume 19 grand on there. So let's see what the final verdict is. Now, if you were to own this property, it will be positively geared by about $140 per week. Now, that doesn't seem like a lot of money until if your strategy is to use this investment property to reduce your debt, to pay off your home loan a little bit more sooner. This is how it will play out, and this is how the property will help you pay down your home loan quite significantly. So let's assume your home loan at the moment is about $600,000. And you have about 5 years left on there. You're on a 6.4 interest rate. It's variable and you pay it monthly, but we're going to change that to weekly payments because, again, making your repayments on a weekly just helps you pay down the debt a little bit more faster, a little bit more sooner. All right, you're paying it weekly, and you're making $140 a week in extra repayments from today. That means it will save you about $134,000 on your interest overall long term over the next 25 years, and save you about 5 years and 16 weeks of your mortgage. That's how sooner you'll pay it off in. So instead of paying it off in 25 years, you're now paying it in 20 years almost. You're done with your home loan. That's just in the worst case scenario. In the first year, all the interest rates right now are relatively higher. What if the rates go up? For example, because I like to work with both scenarios. So say, for example, they go down to 5.7. Then essentially what that means, and you're paying $140 a week, and you're actually starting this journey right now. I'll have to change this. But essentially, the point, what I'm trying to stress out is how significant the years. So it'll save you 6 years and 20 weeks if the rates do go down. Well, what if they go up? Say they go back to 7%. Worst case scenario, right? It's always good to play with both scenarios. It's still almost pretty much the same. It will save you about 6 years and 34 weeks on your home loan if you have that extra $140 per week repayment towards your home loan. So that's the opportunity we have. It's in Truganina. Really good location, very central. You've got shopping center right there. You've got the Kmart there, and then you've got Woolies. You've got schools all around, and then you've got the train station just close by as well. And they're opening a second train station, as I mentioned, somewhere around here, around Riverdale. There'll be a second Tarneit train station, and the reason why they're doing this is because the population just keeps going up and up and up and up and up. And that's the opportunity we have today. And I wanted to share this opportunity with you. We do have packages starting at a lower price point, but smaller homes. But for anything as big as a 5-bed, we're talking on average $805,000 for a 5-bedroom, 5-bath house with a double car garage. Awesome. Cheers.